So folks, what is this video really about? It's about another one of my idols, and that's Buffett. Well, last year he started significantly reducing his stock holdings and holding a large amount of cash, which made many people worried, wondering if he foresaw an economic recession. Buffett doesn't predict economic recessions. He doesn't want to speculate recessions. But it's clear that he saw things earlier than I did. The geopolitical risks brought by Donald Trump. If these geopolitical risks, if some part of it is realized, the current US stock market is obviously too high. The current US stock market is built on the assumption of continuous interest rate cuts, isn't it? Berkshire in the fourth quarter of the year 2024. Why am I mentioning this? Because he's about to retire from his position, right? I'll review Berkshire's performance and his investment philosophy. I'm just a humble outsider, a disciple who has been following his work. I intend to learn about Berkshire, of course, to learn from Warren Buffett. But I started learning quite late because I was too busy before, and now I'm gradually learning. Their fourth quarter profit was $14.5 billion, a 71% increase from last year, exceeding the market expectation of 98.7%. First, you need to understand Berkshire's profit, right? There will be significant fluctuations because the market value of their stock investments is calculated using the public market value. So it can fluctuate quite dramatically, which is really surprising, right? The annual sales were over $371 billion, which is an increase from last year's over $364 billion, but it is lower than the market expectation of $371.9 billion. The annual net profit, a remarkable $888.9 billion, nearly $90 billion USD for a company with $1 trillion stock value. Its PE ratio isn't high because you wouldn't expect it to have very high growth. It's lower than the $96.2 billion USD in 2023, but it far exceeds the market expectation of $60.7 billion USD. Now, how does its profit come about? You understand that Berkshire is organized into two parts. One part is its actual business operations. They have a holding company that invests in these businesses, with the largest being insurance. Insurance accounts for $100 billion, with reinsurance being particularly well known. This is quite impressive. I know someone who works there, which is quite impressive. This includes manufacturing, which is quite impressive. McLean, this is about services and retailing, meaning that this is, well, the pilot is something they do themselves. In reality, their company directly manages it, meaning it goes into their balance sheet. And these must be associate companies. The revenue is $371 billion, increased by 2%. The cost of these things is, of course, quite significant. So, how much money do they make? Earning 15% is already very good for this kind of business, with a 15% profit amounting to $53.9 billion. Their stock investment gains are over $52 billion. Then, adding other factors, it becomes a total revenue. After deducting taxes, which amount to $20.8 billion, they are the largest taxpayer in the United States, with a net profit $889.6 billion. $896 billion. That is for Berkshire Hathaway. You have to admire its stability consistently, outperforming Standard & Poor's by margin now. Last year, its per-share market value grew by 25.5%, which was slightly above Standard & Poor's 25.05% for the same period. But if you want to buy a share of this stock, you can attend the meeting at Berkshire. 750 per share for Berkshire's A shares. Whoa. I previously made a mistake saying A shares and B shares are the same, but the voting rights are different. Its current market value is 1 trillion. Its price to earnings ratio is only 9.6 times, which is very reasonable, but you have to understand that it is an investment company. This is the most important part. It's almost a summary of his entire life. From 1965 to 2024, nearly 60 years. Berkshire's per-share market value has compounded at 19.9%, while the Standard & Poor's has grown at 10.4%, an additional 10% each year. What is the result of an additional 10% each year? Over 60 years, it's a huge leap. Back in 1965, when he started investing, or rather in the 1950s, he pooled together $100,000 of his own funds, calling on his mom and relatives to contribute money, which was just $100 each. If he earned more than 25%, he would distribute dividends. That's how he built his fortune. That's how he increased the volume. From 1964 to 24 years later, it grew 50,000 times. Meanwhile, S&P grew 390x. That's 120 times more. 5,000 times. In 1964, if you had invested $10,000 in volume and left it there, today it would be 550 million. Of course, if you managed to survive 60 years, that's one thing, right? Yes, you only needed $10,000. This is truly my idol, averaging an increase of 10% each year. Let's look at the comparison over the years. This is his return, and this is the Standard & Poor's. You can see sometimes he outperformed significantly, but in some years, it was a bit worse. One year was a bit worse. Look at him in 1999. In 1999, the reason it was worse was that he didn't invest in tech stocks. But the next year, his growth returned while tech stocks fell in 2000. Wow, even though tech stocks continued to decline, the impact on his stocks wasn't severe. In 2008, he dropped by 31%. As a result, the overall market fell by 37%. Then it quickly grew. In 2015, there was a slight loss. But in 2016 and 2017, it surged back up. In 2021, it was up by 29%. In 2022, with interest rate hikes, these made a significant difference in valuation. He still had a 4% gain, while the overall market fell by 18%. At that time, he still had a 4% gain. You should know that overall, it's 19.9%, 10.4%. It's truly amazing, truly amazing. Countless people want to learn from him, including myself. Most of them are from private schools in the East, that's it. It's very difficult for you to consistently apply his methods in learning. I can't fully grasp it. If I had learned his methods a few years earlier, I wouldn't be in business. I should have invested all my money in learning from him. That's it. Or you could just invest in his company. By the end of 2024, 71% of Berkshire's equity investment market value was concentrated in 5 companies. You can see what kind of companies he buys. He waits for the companies to succeed before buying them. Simply put, banks. Apple, Coca-Cola, Chevron, Occidental Petroleum, and Apple make up 28%, right? One is American Express, which he has been buying for a long time. And then there's Bank of America, Coca-Cola, right? One is Chevron. And then there's Occidental Petroleum. I followed and bought some. Occidental Petroleum. And up to now, it's still at a loss, right? I followed him and bought a little bit of Occidental Petroleum, and it's still at a loss. Berkshire sold $10.1 billion in the fourth quarter, only buying $3.4 billion, resulting in a net sale. Berkshire Hathaway bought one company, a Constellation Brands. It's Constellation brand. The market value of the holdings is $1.2 billion. This was the only stock they built a position in this quarter. Let's see if you want to follow. Constellation, which is the second largest beer brand in the United States. Recently, one of their beers won against Budweiser's light beer to become the best-selling beer in the United States. Remember Constellation brands. If you can get into this, you can slowly build a position, really. Berkshire significantly reduced its holdings in bank stock. Reduced holdings in Bank of America by 17.14 points, significantly reducing bank stocks like Citibank by 73.5 and First Capital by 18.5. The only reason to reduce holdings in bank stocks is if you believe there will be systematic danger, meaning systemic risks in the financial system, or the potential emergence of a large amount of bad debt, or the interest margin will narrow, reducing bank profits. There are only three probabilities, and you can decide for yourselves what ABC is. They still hold up to 300 million shares, while Apple holds up to 1 billion shares. This is about Apple. Currently, 300 million shares are valued at 75.1 billion, still by far the largest. They have already stopped buying. American Express at over 40 billion, Bank of America at over 20 billion, and Coca-Cola at 24.9 billion. This includes Occidental Petroleum, Moody's, and Kraft Heinz. You can follow their purchases here. Follow their proportion to buy. Follow their proportion to buy. And then you can create your own version of Berkshire. Whatever they buy, you buy according to their percentage, right? It's not impossible. Just wait for the market to dip a little. This is one method, which is to completely copy without trying to be clever. Berkshire has increased its holdings in a pizza company, Domino's Pizza. Increased holdings, again, a swimming pool supplies company, Pool Corp. 48% is in consumer stocks. They say this company delivers pizza very well. I don't know. I'm not American. This is about the swimming pool supplies, meaning all the things for poolside, like those sun lounges you lie on, and those tools. That's what it is. The most noteworthy thing is the cash and cash equivalents of Berkshire at the end of 2024. $334.2 billion, reaching a historical high. Never before in the world has a company held so much cash, $334.2 billion. The cash here is approximately $3 trillion. You see how they have always consistently held cash. Just holding cash like this. Reaching this point, they started from here. Increasing cash holdings started here from 201 something to 2022-23, suddenly skyrocketing. Over 300 billion in cash, their cash as a percentage of their total assets. Once in 2005, they said every time they did these things before 2000, it was 12%, then a stock market crash. In 2008, they held it so high, resulting in a stock market crash. Is it a stock market crash now? 27% in cash, which is about 30%, leaving 70% in cash. Roughly half of it is directly invested in companies, and the other half is in the shares they bought. Berkshire has been increasing its cash holdings for the 10th quarter over more than 2 years. They are very patient, letting the market continue to rise. In the fourth quarter, they did not conduct any stock buybacks and stopped buying back their own shares. Why? Because they said their own stock is too expensive and not worth buying. The large cash reserves are due to the significant sale of Apple shares, with their Apple holdings dropping from 6% to 2%. Wow. They used the proceeds from selling stocks to buy short-term government bonds. In 2024, they sold $143 billion worth of stocks and invested $9 billion in stocks. If the stock market faces significant risks. Now let me remind everyone, if the stock market faces significant risks, if the stock market drops by 30 to 40%, their stocks will also fall. But the biggest beneficiary would be Berkshire. They hold a massive amount of cash, allowing them to invest under extremely favorable conditions. I observed this in 2008 when they invested in other companies, and they were the biggest beneficiaries. If the market truly experiences a major correction of 30 to 40%, remember what I said here. In Berkshire's 60th annual shareholder letter reviewing 2024, it mentions that he has started using a cane. But what's the biggest advantage of his cane? When he stumbles, the cane supports him so he doesn't fall flat on his face. He's very humorous, like a child, and he still eats hamburgers and drinks cola. The time for Abel to take over as CEO isn't too far off. He should make it to next year at 94 or 95 years old. This Abel, the designated successor, was mentioned in a letter where Buffett shared his fond memories of Berkshire's former COO, Munger. He really misses this old friend, with whom he started the business together. Even at last year's annual meeting, I asked for his opinion. Oh, he mentioned that he knew about his passing. He published a special book commemorating 60 years of Berkshire. Includes great photos and rain recordings. Buffett emphasized that although there are concerns about Berkshire Hathaway's large cash holdings, most of the company's funds are still in stocks. The majority, really, of funds will always be in stocks. Remember, I said this. There's no need to follow all those books on the street that teach you to diversify your investments. There's no such thing. If you can withstand the impact, you don't need to diversify. This is why buying stocks always yields the greatest returns. Always put your funds in US stocks, and currently about 65% is in stock. Okay, let's talk about 3 more points. He wrote a letter about Japan's investment strategy. He used Japanese yen bonds to buy Japanese stocks. This is smart. If he didn't use Japanese yen bonds to buy Japanese stocks, his mother wouldn't even recognize the loss because the Japanese yen exchange rate has dropped so much that she can't. He issues bonds in Japan using yen to buy Japanese stocks, so the fluctuations of the yen have nothing to do with him. At the same time, he gets a stable dividend income and needn't withdraw money, because with his reputation, he can borrow money. Regarding his investment progress in Japan, in July 2019, he purchased 5 Japanese trading companies on trading companies. Investment cost $13.8 billion USD. Market value is $23.5 billion USD. These 5 trading companies include Itochu, Marubeni, Mitsubishi, Mitsui, Sumitomo, with more gains after the exchange rate dropped a lot. Buffett expects to receive a dividend income of $810 million USD from his Japanese investments by 2025, which means distributing $10 billion in dividends to him with a market value of around $200 billion, approximately 5%. What about the cost of borrowing in Japan? It's a white glove operation creating value. Over $600 million USD annually from $130 million USD. In 2024, they paid $268 million USD in taxes to the National Treasury, accounting for 5% of all corporate taxes in the United States, setting a new record for corporate tax payments in the country. Impressive, isn't it? A company paying 200 billion Hong Kong dollars in taxes, which is 5% of the US total, means that across the entire United States, this company's taxes amount to 500 or 600 billion. With US corporate taxes being around 600 to 700 billion, the overall US expenditure is about 6 trillion. There is approximately a deficit of over $1 trillion, with $3 trillion coming from personal income tax. So now, Donald Trump is using tariffs to replace tariffs, which account for 2% of US revenue. If you want to replace the $3 trillion in income tax, the US imports $3 trillion worth of goods every year. If you impose a 100% tax, would that be enough? But no. Even if you impose a 100% tax, some goods would be produced domestically, leading to fewer purchases. and you wouldn't be able to cover the income tax amount in principle. You would need to impose a 200% tariff, and then approximately the tariff could replace the income tax. But the biggest issue is imposing a 200% tariff if Donald Trump's other plan really succeeds, and those companies actually move their factories back to the US. Then no tariffs. Right, so if there are no tariffs, then the US government would have no revenue. So would they have to reintroduce income tax? Okay, that's a side note. Buffett emphasized that he would never prefer cash or things like that, and he is more willing to hold quality stock, whether it's a controlling interest or partial ownership. I've mentioned before, over 300 to 400 years, investing is the most advantageous thing. That is, we know, holding these stocks. This is the worst investment. What is the worst investment? Holding silver is nearly the worst investment. Sintong mentioned that the insurance business is also a core business of Berkshire. In 2024, Castle profits. This is episode 90. With its own $9.02 billion insurance investment income, it invests in other people's insurance companies to earn over $13 billion, meaning $20 billion comes from insurance companies. The company faces challenges brought by climate change. What does that mean? Does it mean that due to climate change, suddenly a lot of money needs to be paid out? In 2024, although there are no catastrophic events, the losses from those storms are increasing. Fortunately, the LA fires didn't cost them a lot in payouts. They didn't pay out much. Berkshire will not use options or other forms of unilateral compensation. If shareholders lose money, the management also loses. This method encourages cautious behavior. They won't give options, meaning the profit sharing is based on actual profits. This is a good thing. Now, let's continue discussing why we are summarizing Berkshire. Firstly, it holds 1/3 of its assets in cash, which is an unprecedented amount. The main reason is that stocks are overvalued, and they believe stocks are overvalued, like the Nasdaq and the S&P. Currently, the earnings and the PE ratio are at 22 times, while normally it's 18 times. This means you can expect a drop of 20-30% before it stabilizes. The 22 times PE ratio mainly comes from the high PE of the top 10 tech companies, which you need to understand. So, are these tech companies without certain risks? I will discuss this elsewhere, but anyway, the bigger risk right now is the risk associated with Donald Trump. Secondly, he mentioned that he will definitely buy stocks. He holds 1/3 in stocks, 1/3 in cash, and the remaining 2/3 in stocks to offset inflation. Thirdly, he talked about his very successful investment in the Japanese yen and plans to increase his investment in it. This is the main message he conveyed to us. He emphasized that Berkshire is prudent and will not buy unreasonable things just to stay in the market, as that would be equivalent to suicide. I will not buy something at an unreasonable price just because I want to hold stocks. Berkshire is looking for new investment opportunities, but remains cautious in the current high valuation environment. Only when the price is reasonable will they proceed with the investment, which is something I've only done in recent years. Investments that you don't understand are not alarming at all. The way to buy a stock when it falls is to buy something below the average price over a long period of time. The first and second points are to choose the stock. It must be a promising stock. So the short-term fluctuation is not important. If you keep buying in the long term, you must buy it, especially if it falls, you buy more. If it falls, you buy more. But you have to be satisfied with the money first. Is the average price you buy at always low? As long as the stock truly has potential, your investment will definitely make a lot of money, right? His explanation for reducing holdings in Apple's tech stocks is that the current valuation is far above the level when he initially built his position, which is too high. Fixed-rate bonds cannot withstand currency depreciation. Buying bonds will make you poor. And quality companies usually handle currency uncertainty. That's it. Actually, the most important thing is the return on equity when evaluating a stock. I tell you, when looking at a stock, it's about whether it can sustainably be in a favorable position, whether this business can rapidly increase the stock, whether sales can increase sharply, and at the same time, whether the profit margin can be maintained. Is this the second point? So why is that? It's because it has its unique proprietary technology, though. Does its proprietary technology have a moat? Or will it be diluted by others? Will it be diluted, affecting the company's finances? Is it stable? These are the most important things. The capitalist system has its flaws, but it is incomparable. In the 235 years since the founding of the United States, progress has surpassed even the most optimistic imaginations of 1789. So those people who are still talking nonsense, like if the US isn't a hegemon, how can these companies make so much money? Others can restrict you, right? If everyone follows the American way of make America great again. Hey, they don't know how to learn from Europe or China to scare themselves by driving you all out and now creating their own Alibaba, WeChat and such. Do you think Europe can do it, scaring themselves into making a phone? What money are you making then? I'm asking you, is this it? The 7 big companies, especially Wall Street. Wall Street lets you make money because you have hegemony. You can control the hegemony of the US dollar and the hegemony of the US dollar. It's because you are the world's police. Do you understand? All right, let's end this segment here.